Okay, let's get going here. We got several things we got to go over, including comp exam and last round and all kinds of other stuff going on. So let's talk about the comp exam first, just so I don't forget. I've handed out for you guys here in class a little packet. By the way, the packet doesn't have anything, I don't think, but a sheet of paper in it with your registration code. That's going to be the main thing. I think I just did finish setting it up. You guys should be able to, when you log into CapSim, you should be able to see now. It'll say that there is a CompXM exam associated or something like that, maybe. Give that a try. It may or may not today because I just set it up today, so shame on me. I should have gone in and had it set up. Anyhow, mess around with that again today. If it doesn't show up, let me know. Okay, for you distance students, for sure get in there and start messing around. For you distance students, I'll email you your codes. I'll just type them out and email them to you guys individually, because that's all you really need to get into that CompXM game. Okay, the thing to be careful of is you'll get to a screen and it will ask you for money. Okay, you have already paid for this, so don't give them any money. Don't reach for your credit card. Don't do any of those things. There's a place on that screen where you can click and it'll take you to then the screen where you will enter your code. And not getting to look at it myself, it's hard for me to remember or describe what it is you're looking for there, but just look around on that screen and there's something that'll say, you know, probably enter code or something like that. Okay, you can get in here, you can log into it, you can take a look at it, you can do those types of things without any problems, right? You can also start and stop the game. Okay, so you can get in and you can, for example, I think there's 5 rounds that you play in the CompXM, and then you're going to answer questions after each round. So you could get in and play the round, and you could stop, and you could go back and answer the questions a week later if you wanted to. Might not be the brightest, because then you might not remember as well. So you might be better off if you set aside some time to play around, to get the results, answer the questions, and then move on to the next. From my experience and from what students have told me in the past, you know, to plan on maybe an hour or so for each round, and the questions would be appropriate. And you might even give yourself some room on the outside of that in case it does take you a little bit longer. The questions are difficult. Okay, the questions are difficult, so not necessarily dissimilar to some that I've asked, where you get your calculator. You might want to have your calculator, you know, be ready to use the calculator on the computer or something, because you might need those tools to answer some of the questions that are on there. Okay, so. And be prepared. Do your best. Does this count some for your grade? Yeah, it counts for your grade. I think I upped it this semester to I think 10% of your final grade. So it's not a, you know, it's not a do or die thing. Okay. I will tell you this: if you don't finish the CompXM, you'll not get a grade. Okay. So it's absolutely required. Okay. And you'll get a good grade as long as I feel you've given it your best effort. Okay, that's what's important here. What this is in large part our assessment tool. Okay, it allows us to see how we're doing. We get some pretty nice reports from this that tell us in the various functional areas what you guys have learned in your 4 years here at Northern. Okay, so it gives us some tools then to take a look and see if there's areas that we need to change. Okay, so that's kind of the primary purpose for this. If I didn't make it worth something, though, then everybody would blow it off, and so I needed to make it worth something. So please give it your best effort. It's the only final that you have for this class. Okay, so I appreciate that. Let me know sooner rather than later if you have any problems logging in. Okay. And again, you can start, I think, anytime and work through it. It's self-paced, so when you finish a round, it'll automatically, you know, go forward to the next round. So you don't have to wait for me to process it or anything like that. It'll just automatically go Maybe after you answer the questions, you might have to answer the questions, but it is self-paced. So, okay, any questions about that? You guys got where you can see it now or anything? Does it show up if you log into just capsim.com?
It shows up, but you can't click on it.
Can't click on anything yet? Okay. It might have to wait a day. In my instructions it says you might have to wait a day. I thought I did some fixing that might open it up for today, but you might not be able to get logged in until tomorrow on it. So again, feel free. The earlier the better. Keep your, you will have to pay if you lose your little deal, because I don't have any record of that otherwise, right? I don't have any record of the codes otherwise, so make sure you do not lose your little code packet that I gave you. Okay. Okay. And you can ask questions, you know, like I said, you don't have to finish that this weekend, so, you know, log in, get that part figured out. If you have some questions about it, we got plenty of time between now and the end of the semester, so you can ask questions and we can get those things figured out, or you can call their help desk too. So let's go. Assignment from round 3, competitive round 3. The first question was, how much did Chester save in variable costs as a result of its investments in TQM? It's an imprecise calculation. You could probably calculate this for your own team, because you'd have the access to enough documentation that you could more accurately calculate this anyhow for your own team. But it's difficult. You don't have enough information to do it for another team. I picked Chester specifically because since they were the winner, they didn't have to do the question, right? And so you guys could just look at it and kind of make some guesstimates, right? Make some assumptions. I think the most common mistake that folks made is that they took the full amount of the percent savings and they actually added those together, okay, and then they took it times the variable cost. But you wouldn't do that, because your variable costs are already added together, right? Your variable costs are already your labor costs and your material costs. And if we look at it, I gotta get back into there, sorry, we'll do that. If we look at those variable costs, just to give you an idea, I think the total is around 120 million, if I'm not mistaken. Oops, let's go up here. So Chester's variable costs, when we come down to the income statement, were about 130 million, just short of 130 million, right? Okay, roughly half. It's not half and half, okay, and it doesn't matter. It depends on how you do your math, I guess, how you want to divide it up. And there's a number of different ways you could kind of come to an imprecise answer here. But let's say it's half and half. You know, you'd have roughly 65 million of labor costs and roughly 65 million then of variable costs, and then you could multiply that by the percentages. So you could have done it that way. Okay, it's not quite 129 million because Chester had some carrying costs. You see, it gives us what our variable costs are, right? They're labor and material and carrying costs. Carrying costs being those costs that are created revolving around the inventory that you have, right? And they did have a little bit of inventory, not a bunch, but they'd have had some carrying costs that were involved with this. Probably maybe a couple million. So most of these costs, 129 million, would be associated with your labor and your material. And you could kind of divide those in half. That would have gotten you pretty close. And multiplied the one by 5.24 or whatever it is, and the other one by 7.24. Go down and look at what the TQM numbers are. Right, yeah, 5.24 and 7.22. Okay. I made these assumptions. I just did a little bit different. I just averaged what those variable cost savings were, and my average is so-so. Okay. I took 6% just because it's a nice round number, right? It's probably closer to 6.2, right, would be the actual average. Okay. And I took about 125 million in variable costs because I took a guess at what carrying costs would be. Again, this is imprecise. This is just kind of back of the napkin types of figuring, okay? But this type of back of the napkin figuring is really kind of cool because it tells us, they invested $17 million in TQM, right? That's an expense that came right off their bottom line. That's painful, right? Except for even right away in this first year, then when I do my back of the napkin type of calculation, they would have saved $7.5 million in just variable costs. Okay, they saved $7.5 million in variable costs. So now their cost is down $9.5 million, right? Okay. They also saved some money in administrative costs because they invested in some of those things. They also increased their demand substantially. They also did a lot of other things. And so when you calculate those things out, again, and these are imprecise back of the napkin types of things, but it would tell you that their actual cost in that first year was substantially less than the $17 million that showed up on their income statement, okay? Because of the other contributions that were made that are kind of hidden in some other numbers, right? The variable cost number, savings, you don't see because it's hidden in what their total variable costs were, but the variable costs were probably lowered by about $7.5 million, $8 million, somewhere in that neighborhood, okay? Question 2, kind of all over the place in terms of the answers there. I think I had 1 or 2 that seemed to have gotten pretty close. But what would Erie's ROE have been if its cash position had been exactly 0? And I just wanted to demonstrate here what happens, if you take out cash, okay? This will be a bigger issue as the game goes on, maybe. For teams that are doing well, it'll be a bigger issue. You might start accumulating a bunch of cash. And you got to decide what the heck you're going to do with that cash, right? Because cash is not always the best thing, right? Sitting on a whole bunch of cash does what? It increases your assets. If you're sitting on a bunch of cash and it increases your assets, it means it also increases your equity substantially, right? And cash is the easiest thing in the world to get rid of, right? Anybody will take cash. You just got to say the word and people put up their hand, right? Anybody will take cash. So cash is really easy to get rid of. The ways to get rid of it, number one, would be make investments that you might into your plant, equipment, automation, those types of things. But what happens if you run out of those types of investments? You just don't think that you can make a lot of money anymore investing in that. It talks about TQM, that there's a law of diminishing returns, right? When you get to a certain point in TQM, your investments no longer really pay off that well. Okay, so, and the same might be true. In fact, you're limited as to the total amount you can invest in automation, and you're limited in some of those areas. So, what happens then if you do all that and then you still got cash? Okay, the other ways to get rid of cash then is going to be dividends and buying back stock. Dividends and buying back stock. Okay, and my point here was, so what happens if Erie would have, say, paid a $20 million dividend, basically? $20,716,000 dividend, or if they would have bought back stock or some combination thereof for $20,716,000. In either case, it would have reduced their assets by that amount of money, and thus it would have to have reduced its equity by that amount of money. Okay, so its equity with the cash, $77,586,000. It's cash, $20,716,000. So if we took out that from our assets, thus reducing our equity, we'd ended up with $56,870,000 in equity, right? Our net income, or Erie's net income, was $6.7 million, and its new equity would have been $56 million or $57. So its ROE would have been 11.79. What was its ROE otherwise? I think it was 8 something. Oops. Erie's ROE was 8.6. Okay, so getting rid of that $20 million of cash would have increased its return on equity from 8.6 to 11.8. As an investor, if I was investing in Erie, okay, here's what just happened. They just paid me a bunch of cash, either in a dividend or they bought back stock from maybe some of the other shareholders, right? So they just dispersed a bunch of cash, and not only did they disperse a bunch of cash, but they just increased the return on my investment then, right? They increased the return on my equity. So 2 good things happened. If they paid me a dividend, I got a dividend, plus I got a higher return on my remaining equity because I got some of my equity back. So the return on my remaining equity, I can take the money they paid me and go invest it in something else then, right? Okay. So it's a big yay when it can be a big yay when you return money to investors. Here's a key thing. When a company's got lots of places to invest that money, maybe they're growing rapidly. If you're Facebook right now, Facebook isn't paying a dividend. Facebook is still growing too rapidly, right? Twitter is not paying a dividend. Twitter's growing too rapidly. Okay, they need to invest that money back into the infrastructure and those types of things that they need in order to keep their company growing. Okay, Apple didn't pay a dividend until just a couple of years ago. Now Apple actually pays a pretty big dividend. Not only do they pay a big dividend, they've also got $150 billion in cash on hand or something like that. They've got shareholders that are pissed off at them because they got too much cash on hand. Okay, I mean, they literally have shareholders that are threatening actions and doing all kinds of weird stuff, saying that Apple needs to pay out some more of that cash. Okay, Microsoft does two things. They pay a really nice dividend, and they also buy back stock at a pretty prodigious rate. Okay, they've got a plan to buy back, I forget how much stock every. They've gone anyhow from 10 billion shares a couple of years ago down to about 8 point some billion shares outstanding at this point in time. So they've bought back, far more than 1 billion shares, and their shares sell for $40 a piece. So they've bought back $50 billion worth of stock over the last couple of years. Plus they pay a dividend that's about $24 billion per year, something like that. No, I might be wrong on that. 40. No, it's not. Their dividend's not that much. I'm sorry. I gotta think what their dividend is here. It's about 3%, about $1. So they probably pay about a $10 billion dividend every year. Plus they buy back, I don't know, 5, 6, 7, 8, 9, $10 billion worth of stock every year. Okay. Why is SID's December customer survey so low? Mainly one reason. Its revision date was at the start of last year, which makes the product relatively old at the end of the year. Some of you got the old part. You didn't really see that revision date. And what I mean by that is Chester screwed up, and they'd gone out too far with that product. I can pick on Chester because they won the round anyhow, right? So they're not going to get too upset if I kind of pick on them. But so they had screwed up, and they had the round before they put their product out too far. Okay, and so it went into this round, so they weren't able to make any changes. And so this round it revised on the first part of January, and as the year went on, that product got to look kind of old. And it ended up, of course, by the end of the year being a really old product. And so the customers, especially at the end of the year, just weren't too thrilled about a product that had last revised, the prior year, right? Basically a full year ago. And so they just weren't that enthused, and that's why its December customer survey was so old. And its perceived age was up to 2.24, which is relatively old for a high-end product. Okay, 4. Erie invested about $45 million in plant improvements. What is the immediate effect on profit? This can be shown in numbers, but numbers are not absolutely required. I didn't get a lot of really good answers here. Okay, I don't know that I got hardly any good answers here. Okay, and this is really kind of important. When you invest in TQM, it is an expense. Okay, that shows up on your income statement as a direct expense. But what happens when you invest in plant and equipment? Okay, nothing. It's not quite nothing. Okay, but it's just an exchange. All you're doing is exchanging cash for equipment, right? So you're just trading assets. Okay, because you don't get to, or you cannot write off that full expense of that new asset. Okay, you can write off a little bit. You can write off depreciation. Okay, and I went through and did a little bit of math. I wouldn't have required you guys to do it, but there might also be an increase, and this is something some of you did get right. Okay, and I hadn't had it in mind, but it is correct. If they had borrowed some money in order to make those plant improvements, they'd have a small increase in their interest expense. Okay, and I didn't look to see if they borrowed any money to make those improvements or not. They would certainly have an increase in their depreciation expense, right? Because all of a sudden they've increased the assets that they have, the fixed assets that they have, and so they're gonna have an increase in depreciation expense. But it's really not that much. Their depreciation from this year was $11.7 million. Their depreciation last year was $8.7 million. So their depreciation increased about $3 million is all. So they made a $45 million investment, and really it made about a $3 million difference in their before tax, okay, in their before tax profit, or about a $2 million difference in their after tax profit, okay. If those investments were for automation, then that decrease would have been offset by savings in labor cost, right? Okay, so actually the net, they made a $45 million. They wrote a check for $45 million for plant improvements. The net effect in that year, in the short term, was virtually none. Okay, it would have been virtually none. Okay, now what's going to happen next year and the year after that? They're going to keep having those increased savings in the labor. Sure, the depreciation is still going to be up there too, but the labor cost savings are going to more than offset that. Partly because as your products are growing, the labor costs are going to keep expanding, or the labor cost savings are going to keep expanding. So, okay. So that's kind of an interesting concept that I think a lot of folks don't get as we're going through this. So, any questions about the assignment? None. No questions about the assignment. Let's take a look at what happened this week then. What happened this week is everybody got thumped except Chester. Chester did the thumping. Chester even thumped the computer teams. Okay, which I'll remind you I predicted that, not that Chester would necessarily, but I think I predicted that in the competitive rounds, by later in the rounds, that you guys would figure it out and start thumping on the computer teams even a little bit. So sales, though, Ferris still led in sales. What happened here, though? Ferris had 42 million more in sales. But actually, even when you go down to the next line, the earnings before interest and taxes, Chester had $1 million more, a little better than $1 million more in EBIT. What's the big difference there? Don't answer, because that's on your guys' assignment for the week. So I'm not going to answer your guys' questions for you, but that'll be on next week's assignment, right? Okay. 42 million difference in sales and yet less earnings before interest and taxes. That's kind of a big deal. Chester obviously did some things to make a huge difference there. It's pretty obvious. It's obvious right on the financial statement here what that difference is. So we had 3 teams that had to take out emergency loans, albeit relatively small emergency loans compared to some that we've seen in the past. Baldwin about 16 million, Andrews about 8, a little over 4 for Digby. Not too big of a deal. In fact, I don't even discount for anything under a $5 million emergency loan. Profits, Andrews actually had a positive, yay. Chester about 19 million, which beat even both of the computer teams, so that's pretty awesome. Cumulative profit I don't really care about. So finally, we got Digby not to sell any more stock, which was really smart because last year I think their stock price was down to $1 or something like that. I mean, they'd had to sell a hell of a lot of stock to get any money coming in. You don't want to sell stock when your stock price is low, okay? You don't really want to sell stock even if your stock price is high, but that's a far better time to do it. So, okay. We see everybody at least got turned around a little bit, so all the teams that were, down here at the bottom, they kind of got things turned around. Chester made a big jump right there in the stock market thing. We still see not a lot of borrowing going on. Andrew some, Erie some. You guys are just afraid to borrow money. I think, I don't know what the scoop is there. Man, you got a rapidly growing business, just growing to beat the band at what, 14, 15, 16%? And you can borrow money at 10, 11, 12%. I know those rates seem kind of high by today's standards, but if you got a business growing that rapidly, because the growth's compounding, right? And the interest that you're paying is not on a compounded basis, and so to leverage into that kind of a situation, that would be every investor's dream. Cash flow, we take a look at some of these things. We see some inventory changes, right? everybody except Andrews, and theirs are just small, but everybody improved significantly in their inventory because there's a lot of leftover inventory last time. But even in spite of those improvements, there's still some inventory, probably a little more than what people would like for this particular round. Okay, huge investments over here. So while Chester thumped them this round, makes me a little bit nervous because both Erie and Ferris are investing huge dollar amounts, right? 54 million and 41 million in plant improvements. And again, what's the cost of that for next round's profits? Be virtually nothing, right? Virtually nothing. In fact, it's probably I shouldn't even say probably. It will absolutely be a net positive because the savings that they'll have in probably labor costs are going to offset anything that they would have in increased depreciation and or interest, without question. Chester did invest a decent amount, more than the other teams. So again, you got your winning team still investing more in plant and improvements than anybody else. Retired some current debt. We did see some borrowing, some current borrowing amounts. Sitting on a decent amount of cash. This makes me nervous. Ferris and Erie, lots and lots of cash, right? Lots of cash now, and they made huge plant improvements, and yet they still have a lot of cash on hand. Okay, so this could be a bad thing, though. Remember, I said cash isn't necessarily good, and in this case, if you look at what this does to their equity, 100 million equity and 112 million in equity, whereas Chester only had 80 million in equity. So I think the difference there on the return on equity is huge, right? Chester doesn't have to make near as much money to have a higher ROE versus especially like Ferris. Theirs is almost 40% higher, just about exactly 40% higher in terms of their equity. So big difference. Exciting there. Decent investments in TQM. Digby did make a huge investment in TQM this time. Chester and Andrews some. Erie and Ferris not so much, so interesting. Still just all kinds of excess capacity, right? Especially Digby. Digby's paying for just all kinds of capacity. Now, they had lots of this, it maybe had been a calculated thing last round because they had all kinds of inventory going into the round. So obviously they didn't want to produce a bunch, and so their production was certainly down for the one round, okay? But, they have the ability to make about 15 million units, and they made about 5 million units. So they're really using about 1/3 of their potential capacity if you count both shifts, right? If you count both shifts, because the blue is just first shift. So you can double the blue, right? Okay. And you see the three teams that are winning are not paying for idle capacity, right? They're not paying for idle capacity. It's one of those concepts we kind of talked about early. It's one of those concepts that's a little bit hard to put a pencil to sometimes when you think that you're paying time and a half for people to come and work, right? But if they're not working, then you've got capacity that's idle and you're paying for idle capacity, okay? But that idle capacity kind of shows up in different areas. Right, depreciation, maybe some interest expense, maybe some things like that, right? Or you've just got too much equity, right? That you could lower your equity and thus increase your ROE if you get rid of that kind of capacity. So, yeah, we still see some inventories. They're not that bad though, really. Right? If you look at the different inventories, Andrews, I'm sure, ended up with more than what they expected in some of those areas. Baldwin not too bad. Chester not too bad. A little bit in the low and traditional. Looks like we're having a big fight in the low and traditional segments. There's lots of action going on there. You get up into the higher ends. There's not too much left over there. Although Digby had quite a bit of inventory in the high end. If you combine their two, they had over 1.1 million units left in the high end, so they missed out on about $30-some million in sales there, close to 40 million maybe in sales. I don't know if there's anything that really jumps out at you on some of these. Like I say, you're really getting clogged up here in the low end. There's lots of products competing down there in the low end. On the other hand, in the high end, there's not too many companies. There's more products. There's only 3 companies, but there's 4, 5, 6 products because some of the companies have introduced new products in those ends. Chester did benefit a little bit in the high end at that time. I'm trying to get their high-end product back to being kind of competitive, though. Performance and size, not many competitors, at least in terms of companies. Not that many products, actually, even so. So they're, that pie is not that big, but they're all getting a pretty big slice of that pie, so it's pretty nice. The perceptual map, yeah, we're lots of battles going on down here. I don't know how many total products we have in the low and traditional segments. It'd be interesting to go count those, but we got a ton of products competing in the low and traditional segments. Not that many up here in the high end. You see Ferris is still, very much right out here in the performance and size. At least Chester is not too far behind, a little ways behind in the high end, but in terms of location. Starting to see some significant, we're starting to see some pretty significant cost savings here. 11%, right, for on the labor side. Baldwin wouldn't have a lot in labor, probably $20–30 million probably in labor, but they're saving $2–3 million because of their investments there every year. TQM, again, Chester had some nice jump ups there. Digby jumped up quite a bit. Reduction, 40% reduction, both for really Chester and Digby, about 40%. That's huge, right? That's huge. So you could, if you made certain changes to move your product that might take a year and a half, it's going to take less than a year now. Right? It'll take less than a year. In fact, significantly less than a year. So that reduction in R&D cycle time is really going to enable them to move some products. This is really, it's not important at all for those of you that are competing in the low and traditional ends. I wouldn't invest any money there either because you don't need to push your products out to the front edge, right? That's a waste of money if you're investing in R&D cycle time. But for the folks that are competing out on the high performance and size categories, it can be an extremely important thing there. So, okay, any questions about the round and how we did? You want to see the spreadsheet? Do we need to see the spreadsheet? I already told you that Chester thumped everybody. They did get whacked, though. They did have one. So their armor is not impervious. They got whacked 5 points for, what was it, working capital? Yeah. A lot of teams got whacked. All the student teams got whacked for not having sufficient working capital. Okay. Part of that's borrowing, maybe borrowing short-term instead of long-term. Okay. And I showed you up above, not many of you guys are investing, or not investing, I'm sorry, not many of you guys are borrowing in the bonds and whatnot in the long-term. And it really depends on what you're doing. I would say long-term borrowing is more for plant and equipment types of purchases. Short-term borrowing would be for TQM and those types of things. You should always try to match. That's what we always preached in banking. You match the term of the loan with the thing that's being bought, the collateral or whatever that's being bought. You don't buy land that's going to last forever. You don't borrow short-term to buy land, right? And on the other hand,
you're saying like 10 years.
Yeah, anything past a year really is kind of considered longer term,
Okay.
right? Okay. Your risk, again, the working capital thing is just a risk thing. Obviously, not a huge risk in some cases, but you're a little riskier if your working capital gets below a certain level. So that's the only reason that's put in there. I would say that, in Chester's case especially, the risk there is extremely low. But could they have managed it a little bit better? Yeah. Okay. Any other questions about that? Any questions about the round? How we did? What you guys are going to do next time? Let's take a look at your next assignment then. This one's too easy, I think. Wasn't feeling too good yesterday. Still not, so I probably didn't put as much effort into making a really good assignment as I could have. Question number 1 is Ferris had the high sales by about 42 million, but Chester had more EBIT. What's the main reason? Okay. There's really about one main reason there why there was a big change there. Okay. Question 2, we've kind of had one like this before. Involves a little bit of math, but it's pretty simple math. What's going to be the total industry unit demand in the high end for next year? So that's all 6 teams or whatever combined, right? What's going to be the total industry unit demand for the high end next year? 3, again, we've done similar ones to this, I think. This one's pretty straightforward. What's Digby's after-tax cost of its TQM investments for this round, for round 4? I forget what they invest, 15 million, I think it was. What's the after-tax cost of that? 4, what's Chester's strategy? So you got to kind of look at it and try to come up with what their strategy is. 5, again, I can pick on Chester a little bit since they won. They don't have to answer the questions. But suppose Chester had bought back 200,000 shares of stock last year. Assume it could have been done. Assume it could have done this with available cash. So assume that Chester could have done it with available cash, meaning they didn't have to borrow any money or anything. Okay, what would its earnings per share have been? So you don't need to go in and try to calculate that their earnings changed or anything like that. It's just a change in the number of shares outstanding, basically, and how that would have affected it. So, okay. And then I also asked what would have been the effect on ROE, and that doesn't require. The first one requires a numerical answer. I want you to do that math, right? The second part of the question doesn't really require a numerical answer, just a one-sentence statement. Should be able to get that done, right? And tell me what the effect would have been on its ROE. Okay. You can take more. I mean, if you want to walk me through how it would affect the ROE, that'd be sweet. Okay. Questions about the assignment? Hey, you guys are just quiet today. You guys are all getting short timers disease, aren't you? I guess so. Big time short timers disease. Man, oh man. Okay, I don't have anything more. My voice is kind of hoarse, and so I'm going to stop. Try that CompXM though. Try to get logged in as soon as you can, and just let me know if you have any problems.